Hello, everyone, and welcome. My name is Amanda Waddell, and I'm the training manager here at BVR. Our webinar today is demonstrating the VFC DLOM Calculator with Marc Vianello. Before we begin, I'd like to remind you that your attendance today is eligible for 1 CPE credit. To receive the credit, you must answer 3 poll questions that will appear during this webinar, and you must complete and submit a brief survey within 5 business days. A link to that survey is included with your login email. It's also available on the event page for the program. At the conclusion of today's program, you'll automatically be directed to that survey. If you're registered as an additional listener, you must be on your own device so that you can respond to the questions and qualify for CPE. If during the webinar you have any trouble with the audio streaming, please try refreshing your screen to fix that issue. We'll take all questions for our presenter using the Q&A chat function on the side of your screen. Again, to receive your CE credit for today's webinar, you must answer 3 questions that will appear at random times during this presentation. Now I'd like to introduce today's speaker. Marc Vianello is the founder of Vianello Forensic Consulting, a CPA firm licensed in Kansas. He has diversified experience in accounting and auditing, taxation, finance, entrepreneurship, and general commerce since 1975. Marc became keenly interested in the topic of discounts for lack of marketability in 2007, which led to the development of the concept of probability-based DLOM. The concept evolved over the years, culminating in the release of his peer-reviewed research that provides strong statistical support for the probability-based DLOM concept and is embodied in the web application dlomcalculator.com, which is commercially available. He has written the book Empirical Research Regarding Discount for Lack of Marketability and has many articles published in peer-reviewed journals. He's been a presenter in several professional seminars for NACFA and AICPA. Our speaker's full bio can be found on the webinar presentation page as well. With that, I'll turn this over to you, Marc. Have a great webinar.
Thank you, Amanda. Hello, everybody. Let's first look at slide number 2. Here's my contact information if you want to reach out to me with any questions, or if you end up using the calculator and need some assistance in working your way through it. And I'd like to call your attention to the coupon code that is shown on this screen. You should write that down. Don't use it yet. Hold it until after this presentation. But that coupon will allow you 1 free project on the calculator. It expires April 30th is when it expires. So you need to sign on and use it before then. Registration, by the way, is free, of course. And you can share this coupon with others in your firms and anybody else, but each person has only a one-time project code on it. And so now with that, I'm going to start sharing my screen. At least I'm going to try. Amanda, why am I not able to do it?
Are you clicking what you clicked before?
It worked before.
If you click on share content at the bottom.
Yes. And I get a screen that, oh, this is why. Okay. Here is the dashboard that you come to on the calculator when you have logged in. And I've got another screen that I want to present real quick, if this will come up. Let me try this a different way. Well, all right. What I'm trying to share is a document that it's a PDF that has been given to you in the presentation materials, and this is the regression statistics that are applicable to my discussion at the last session. And what it shows is that the analysis that we did of testing the VFC Longstaff methodology against the identified group of 59 restricted stock discounts is very, very strongly statistically significant. It exhibits a T-stat that is at 8.2, which should be T-stat should be in excess of 2.0, and we're at 8.2. It's got a p-value that is 11 digits to the right of the decimal point. It should be less than 5%, and we are way, way, way less than that. It has an F value of 67.4, which is an indicator of strong statistical significance. And of course, it's got the F significance factor is equivalent to the p-value, and so this confirms that the results that we are relying on for the methodology is in fact statistically significant, and it falsified the null hypothesis, therefore provides a scientific basis for the conclusion that the VFC DLOM calculator can indeed predict an appropriate DLOM percentage. This particular PDF that I provided in the presentation materials pertains to a 4-digit SIC analysis. We also did similar tests using the VFC Longstaff and double probability methodology with 1, 2, and 3-digit SIC codes. And what we found is that all 4 of those were very strongly statistically significant, but that the 4-digit code, as you progressed through the number of SIC codes to more and more and more specific selection with the test population, that they became increasingly statistically significant. However, even the 1-digit was very, very strong and therefore statistically reliable and falsified the null hypothesis. Okay, so having dealt with that, we'll go to look at the calculator. We're on the dashboard right now. The first thing that I'm going to do is I'm going to click on the My Projects tab. And you need to have a project to do anything on this calculator. Choices of what you can do are a single probability calculator or a double probability calculator. You can also use a marketing period estimator or a price volatility estimator. The estimators simply do not calculate a DLOM, and they can be used just in a more simplified presentation. I'm not going to get into those right now. They are subsumed completely in the calculators. And what I want to demonstrate is the double probability calculator, because this is the one that I think generally you're going to use. Having said that, there are times when you would want to make a single probability DLOM calculation and add it to a double probability DLOM calculation. An example of that might be that you have a company that you're valuing today, and it's being prepared for eventual marketing, not sale, but eventual marketing in, let's say, 90 days. So you have a 90-day lockout period, but you're subject to price volatility during that period. So you do a single probability calculator using a 90-day marketing period, and you do your analysis to come up with the price volatility that is appropriate. Then you consider the period of time that it would take to actually market the business, and you would use the double probability calculator for that in most instances. But these are facts and circumstances driven, and if you have questions on how to approach that, just feel free to ask and take my contact information. You can email me or call me, and I'm happy to discuss these things. So let's look at an example. I have some previously prepared analyses. Here's one, an oil and gas field machinery project. If I select that one, I can look here at my previous run history. So let's just go back, select. I'm not going to select one of these previous things. They're important for you because you may do an analysis and want to go back, and you can save each one of these that you've done. So you may want to go back and revisit some previous analysis that you did. So here's a double probability calculator. And we're going to pick this oil and gas field analysis, which I've given a valuation date of July 15th, 2022. I'll increase this to show it a little bit better. Now, you would fill out, obviously, the information that you want. Perhaps you'd fill in the company's address. Normally, this would be the name of your valuation subject. You put in your appraiser profile information so that you claim ownership of the result. And now we can start analyzing what can be done with this. Now, here we have a table that I explained in the previous session. This is updated dynamically insofar as the public offerings are concerned. These columns. This column of average private company completed sale days is not updated. That's static in our on this screen. But we are always going out and harvesting new public offerings, and we separate them. Here's all of them. We have here 8,400 since we started doing this. And then we separate them between those that are for successful public offerings and that are first filings, and then the subsequent equity filings. And you can see that the private company sales take significantly longer than the IPO sales, which takes significantly longer than the subsequent equity offerings. You can drill down a comparison of that, and let's say that here we have the 3,000. Let me go back up here. This machinery and equipment is SIC code 3533. So we can come in here and we can say, well, let's look at 35 and 35, just get that range. And we get now a comparison of these factors. Here's what that industry marketing period looks like for 138 transactions that are in the 3,500 to 3,600 SIC code, 236 days with a standard deviation of 192 days. And then if we look at IPOs, we have an average of 84 days, 163 transactions, 84 days, 97.5. And that can be further refined if you choose. This is just to help you focus your thoughts. We can go down to 35, 353, 3-digit code, and we get those comparisons, which change. Now we have in the BizComp database only 7 transactions. You can see we have fewer transactions as we get more specific. All right, so let's say that we want to come up with a DLOM. We have choices. First thing, there are 2 components in all of these, and just for a refresher, we have the Longstaff formula with my modifications. We have the Black-Scholes formula with my modifications. and we have the Finnerty formula with my modifications. Now, the Black-Scholes and the Finnerty modifications are simply that all we're looking at are the time factor and the price volatility factor. We make available to you, but we have set a default value of 0, the risk-free rate and yield rates, dividend yield rates, and things like that are components of those formulas. And those formulas yield radically different mathematical results, which may be applicable in certain circumstances. We'll demonstrate that and talk about that a little bit later. Now, you might want to so you need to come up with first a marketing period, shown here, and then a price volatility. And then here are the formulas. These areas all expand on the website. So if we want to base this on private companies, we can open up our BizComp database. And if we use the entire database, we can display that, and we see there's 16,500 transactions with a average marketing period of 217 days and a standard deviation of 190 days. But we can also be more specific. We can say we want to look at SIC code 3, and we display that. And what we get is now 738 transactions with 238 days of marketing and a standard deviation of 232 days. Now, the standard deviation is very, very important. It's a nuance that I put into these formulas. And this is a bit of a rehash from the previous session, but what we are doing is determining a logarithmic distribution of both marketing time and price volatility over 50 data points each, and then we calculate a DLOM for each data point and aggregate them based upon the probability distribution under that logarithmic curve. When we use a double probability DLOM, it's 50 times 50 combinations, meaning 50 marketing period data points and 50 price volatility data points. So 50 times 50, we have 2,500 data points that for which we are calculating a DLOM and the probability of realizing that DLOM. So that's why standard deviation is very important. If we add, our next digit was a 5. If we add that into our SIC code on BizComps, and by the way, you can download your own selections from, if you have a BizComp or a Pratt Stats, I'm not sure what it's being called right now, but if you have those subscriptions, you can download or upload really your selections from those databases to our website in order to make these calculations. But when we put in 35 to 35, we find that we have these changes in our count drops to 138. Standard deviation changes somewhat. If we put in 353, click display. Now we have 7 transactions, and we have an average of 132.1 and 48.3. So you can determine how precise you want to be. By the way, you can also set in asking price parameters, employee size, annual revenue. You can select the state and government location. Then you can also say that you can be specific on the date. I want, let's say, a sale date that is on or prior to July 15, 2022. So we can see what that does for us. And I have no idea if we're going to have any that work for this, but we'll find out. The point of this calculator is to empower you to make objective, rational decisions that about DLOM that are supportable. So you're not just guessing. And so we click and we find that, well, we have all sorts of parameters in here. We have, let me get rid of some of these. But before I do, you can see that we have here the SIC code parameter. That's where we start. We've got 7 there. Asking price, these big populations, because I didn't limit these counts, so we're getting everything. Let's get rid of these. And we have, in this instance, all 7 that are prior to July 22nd of 2022. So we can argue that, at least with those, that's known and knowable, and absent any other considerations, maybe it's useful for this. Alternatively, we can, and there are other ways you can customize these date selections. I'm not going to go through those unless somebody has a particular question. You can also, in the alternative, select successful public offerings. Oh, by the way, if you want to do your do a selection out of BizComps or Pratt Stats, you click this button. You can choose your file and upload it. You need to use the column heading format needs to be precise. You just use an Excel file with your download, but the column headings need to be precise for this to work, and that's explained in the information that we provide. You can also just put in, you can separately determine a marketing period, average, and standard deviation. Standard deviation can be 0. The average cannot be 0. And so you can run your calculations that way. But the point here is to help you come up with good inputs. So we look at the successful public offerings, and we have choices. We can do all filings, IPOs, or subsequents. Let's look at the IPOs. We can choose equity, notes, mixed, or specific factors. Here we're going to do, again, we'll do 3, SIC code 3, 1-digit code. We will just go ahead and take all regions and get all transactions. And what we're doing here we go. So we have, what we're doing here is we're measuring the time period that elapses from filing, that a company has, from filing an S1, an initial S1 in this case, with the SEC, and then the approval date by the SEC, that as the marketing period. There might be as I said before, there might be an extended period of time between that precedes the filing date when a company is getting its act together in order to be able to file. Maybe the decision was made a year ago to become public, and a year is elapsing or anticipated to elapse in order to be able to get necessary audits done and the prospectus prepared and so forth. So you might do a 1-year single probability DLOM that has price volatility probabilities of price volatility, but a 1 year time period, and add it to the probability, the marketing period probability that is shown here, 95 days with a 99 day standard deviation. But again, this is going to change if we get more specific. Let's see, we were at 3.5, I think, and 3.5. And now we have now we find that we have 169 transactions with 86.5 average days, 99.2. And here are the companies that comprise this 169. They're all in here for you to be able to review and select, but 169 is a very long list. You might want to just scroll down here, for example, and say, well, here's ESAB that took 3 days. There may be some reason why you would want to exclude ESAB. Let's see what else we have. There were some that were in the 300 range, but since we have 169, let's see if we can get more specific. So we'll scroll down and we'll go to a 353. Display our marketing period. We now have 26 transactions with a significant increase in the average marketing period and the standard deviation. Let me say one thing that's kind of interesting out of this. When standard deviation goes up very high, typically DLOM is going to go down because you're spreading out occurrences to very low probability events. It's kind of counterintuitive. But in any event, we look at these and we know we can see these and we know we're going to end up with 35, 33. So maybe we want to exclude Columbus McKinnon. We can do this more specifically. Let's go ahead and change our parameter to 35, 33. And we'll select that. And we now find that we've got 20 transactions that are in that specific code with 131 days of average marketing period and a 210-day standard deviation. And again, we can then scroll down and see, well, what's going on with WH Energy? Should it be eliminated from this? It took over 1,000 days to pass SEC registration. These others are much more consistent. So let's say we elect to keep all of those except that one, except for this one. And so we'll click again. We can also, as before, pick a time period. So let's say that we do not want anything that is after July 22nd of 2020, what was it, 2017? Let's see, I've forgotten now. July 15th of 2022. So we're going to exclude anything that is after July 15th of 2022. And here we have that. Click display marketing period again. And we find that we have now 18 transactions with an average marketing period of 87.1 days and a standard deviation of 56 days. So you can see what happens as you refine your analysis. Now, there could be innumerable reasons why you would accept or reject the transactions that are in this list. If you want to review them, you can click through to the information about the particular transaction that's available on NASDAQ, or you can click the SEC file number and be taken directly to the SEC and look up whatever documents you want in order to refine your choices. There may be, and I want to point out that the ones that are applicable to your situation may not be the ones that are the shortest time period. It may not be the ones that are the longest time period, but it could be the shortest. It could be the longest. And therefore, a solid analysis of marketing period, and this is going to be true on price volatility as well. A solid analysis involves your judgment to take this tool and consider which of these guideline companies are most applicable to your evaluation subject. You can also use a date that's after. You might want to know what was happening in the time period that is your anticipated marketing period. So assuming that you are past your marketing period, you might want to use that information. You may not have known it. A person may not have known it on July 22nd, July 15th, 2022. But if you're doing your evaluation in 2024, it might be relevant to your considerations to know whether or not the marketing period at the SEC, or for that matter, for a private company, has changed. So we put in that date and we click, and we find that I only had one transaction that was after that date in that 4-digit SIC code. You could, of course, back it down. Let's see if we gain anything by going to 353, I'm sorry. And we gained nothing there. Back it down another digit and see if we gain any transactions. And now we do. We now have 11. But you have to decide, are these transactions in a less specific code? Here's one that's in our industry. That's the one that we got before. You have to decide if these are sufficiently similar to justify using a 91.5 day marketing period, average marketing period, with a 111.7 standard deviation. Maybe so, maybe not. Let's go back to what we had, which was this one. And then there are other things you can do. You can select time periods between two dates. I think there's a time limit on how far back and how far forward that goes. You can look at filing date. You can look at approval date. We give you information so that you can make an informed judgment. But you have to do your research ultimately. You're coming up with guideline companies, whether they are private sales or public companies. They are still guidelines. And so now we'll move on. We have a selection. Again, let me go back to the 353. So again, here we have 19 transactions. We excluded the one that was very long. Now let's look at price volatility. You can put in your own average, your own standard deviation, however it is that you may have come up with those numbers. Standard deviation can be 0 in both instances for marketing and for price volatility. For publicly traded stocks are the source of our price volatility. Always has been and always will be. And this whole methodology dovetails very nicely with the way we come up with cost of capital in business valuation, because it's all based on the analysis of publicly traded stocks. So then you have to choose. All of our price data comes from a company called Alpha Vantage. I can't remember ever using the reported closing prices. I use the split adjusted closing prices. I'm going to skip these boxes for the moment. And we can get all price volatility days. We end up having to make a selection. So let's first go here, and we're going to say, okay, if we do a search with a search by factors, we're going to do a 1 digit again, same drill, and see what we come up with. And that gave us all of these companies. Now we're going to come down to 10 of them that we select. But you can see that in here, again, if you want to click through to the company, there's the SEC link so that you can decide if you want to add it. But we can see that we have all sorts of different industries, segments in here. And we're interested in 3533. So we don't really want all of that. We're going to go back and let's just do the step-by-step drill down. Putting in 2 digits, there are 50 results. Let me see how many we had before. Well, there are more than 50 results. Here are 50 of them. So we need to get down below 50. So we put in 2 digits and we're finding that we still have more than 50. And we can put in 3 digits. Remember, specificity is a strength. We want to be as close a match to our valuation subject as possible. So if it's a company in the 3533 code, we want to be able to get down to that. Now here we have Caterpillar's in 3531, Dover's in 3530, and so forth. So let's conclude that those are not relevant to our valuation subject, and we're going to go to the 4-digit code. Now, I'm going this way just to demonstrate what's happening in the database. You presumably would start with the 4-digit code, and if you find satisfactory guideline companies at that level, that's where you're going to stay. You're not going to do what I've been demonstrating here. So we search for this, and we find that we have 17 results that are in the 3533 code. And you can now, we have to add, this add button populates this field for doing a price volatility lookup. All of these are in the same industry. It may be that the best answer is to go back up here to the marketing and find these companies. So we have DTI and WHD. WHD will add that one. Here's DTI. We have SEI, these companies had filings, but they're no longer public. So SEI and FET, FET, we have OIS and INVX. And by the way, the fact that there's no price volatility might be a reason to exclude some of these from the marketing period. We can look at that later. And then we had NOV, and that's the last one. And here's NOV. So by clicking add, we populated them into this field, and now we can display the price volatility. And here's what we find with these companies. We've got 1, 2, 3, 4, 5, 6, 7 that seem to be pretty darn consistent. An overall average of 38.6% price volatility with a 42% standard deviation, encompassing a large number of days, going over a large period. So we don't want to be past our valuation date. And so let's refine that. We will go, we're going to do a look back from our valuation date of 250 days. That's 1 year of trading days. And we'll search for that. And we'll display. And now we find that DTI isn't relevant. So without DTI, we have an average price volatility of 41.7, 34.8% standard deviation, 250 days, all of it's prior to our valuation date. And with that, we can now select a formula. Let's start with Finnerty. The Finnerty formula is very frequently used for fair value accounting as opposed to business valuation. So we make it available. If any of you are using that, you can use this tool to come up with your Finnerty-based discount on a fair value accounting. If you think it's relevant to put in a risk-free rate, you can do it here. You can put in the dividend rate here. The default setting is 0. We'll just leave it at that. But now, because we have selected those things, and assuming that I did everything correctly, I click the run button and we get a result. And DTI, we're told, has to come out because it's not in the data. So let's remove DTI. It's not in our price volatility data. So DTI is here, and we'll remove it. Now, press that again, it's gone. And we've made our formula selection, and we run the report. Another thing I want to say about these three formulas, they yield very, very different discount percentages, but they all correlate very, very closely with each other. The Finnerty, if I remember correctly, yields about 1/8 of the Longstaff DLOM. Black-Scholes yields about 1/2 of the Longstaff DLOM. In fact, they're very close to 1/8 and 1/2. And the only and that's using exactly the same information. So we'll see that. So here, this affinity discount's only 3.2%. A 95% probability could be as low as 0.7%, could be as high as 5.8%. Maybe that's relevant to your fair value accounting. Here are the marketing stats that were involved in this. And if you want, you can look at a report. Which is like this. Gives you all the information and gives you a series of graphs. We'll look at those graphs in a bit. Sorry, that's my wife. Yeah. I'm fearful that I've clicked the wrong button and lost myself here. Okay, excuse me. I have to get my login. Sorry for the interruption. I'll be with you on this in a minute. Just bear with me. Okay. So we'll go back. Well, we'll go back to our calculator. And let's see, maybe I'm lucky and saved it. I'm not sure I did. Look at our run history. Oh. Here's my run history. Okay. So let's see if we can get back to what we were looking at. Here we go. So that was worthwhile demonstration, actually, in my opinion. So it shows that you could easily recover your work. So anyway, we have that result. We'll come back to look at the graphs. They're available through this spot, but we'll come back and look at them later. So now we don't like that result. We want to know what happens if we use a different formula. And we do that by modifying the options. And we come down here. We can change any of these inputs. So we scroll on down, and now we want to look at it exactly the same way, but we want to use the Black-Scholes formula. So we select Black-Scholes. I'm going to leave all these defaults at 0, 100, 100, 0, 0. Again, if you feel the need, you can fill those in, but my recommendation for valuation purposes is to leave them at their default settings. So we run a report. And where we had, what, 3% or something like that for affinity, we now have 8%. Let me go back and see what that affinity was again. Modify the options, go back and select affinity. Run the report. So affinity with this data set gave us 3.2%. Black-Scholes with this data set gave us, I think it was 8%. .3, and now we'll look at Longstaff with this data set. And we see that Longstaff provides a higher DLOM than the others, and that will always be the case. So in this instance, with this data set, we have an 18.6% probability adjusted DLOM using Longstaff. Now, of these formulas, only the Longstaff formula was actually devised in order to measure DLOM. And as I explained in the previous session, it was only the Longstaff formula that was yielding statistically relevant results that falsified the null hypothesis. But the other formulas, as I have also said, might be useful for other applications, and I leave that up to your judgment. Now, let's see what happens if we just change some of these other options. Let's say that instead of well, here's another thing that you can do. You can select this Monte Carlo box for both marketing period and price volatility, and it will allow you to run the average up to down to the 95th confidence interval and up to the 95th confidence interval. So we're still on our way going up.
I think you might be sharing the PDF screen, not the calculator screen.
Oh, okay. I'm sorry. Oh,
You might have to stop sharing and then do it again.
Okay. I see the problem. Well, let's say I see the problem. Okay, I think we have that. So, all right, so let's go back to our demonstration, which is here. And we can increase by clicking this Monte Carlo box under marketing period, we have the same one under price volatility. We can increase this up to what is the 95th percentile. Any average, which is at 232.4, any average number, any mean value between the 95% confidence interval will retain the standard deviation. So 232.4 we can display that. Let's just go run the report. And we find now that we have a 26.6% probability-based DLOM using the Longstaff formula. We can similarly click modify again, and we can go down to the price volatility. And we can do the same thing down there. Click our Monte Carlo box and raise this up if we want. We can go in the other direction, of course. We can run that report. And we see now we have a 27.8%. But you can also, again, click modify. You can also, as I said, put in your own values. So we could override and we could say we want 400 days and 200 days of standard deviation for some reason. And we can run that report. I'm just demonstrating how sensitive this is to the values. And now you can see we have a 38% probability or DLOM. So what you want to accomplish with this is to look at the values that you're putting in and again determine to what extent the guidelines, whether they are private companies or public companies, you want to determine to what extent they are compatible with your valuation subject. Right now, Akile says, you said earlier that Finity was not for valuation. Which one should we use in our valuations? So what I said was Finity is commonly used for fair value. I'm not saying that that's what everybody does. I just am aware that it is a common formula. For business valuation, I think the appropriate formula is Longstaff. And that, I think, is a good segue into showing graphs. So the report that we prepare has all of that data. Are we going to run out of time here soon?
Yeah, we're actually past time already, so kind of got to wrap it up.
Okay. Well, anyway, you can look at these graphs, and the double probability shows the concentration of where the DLOM calculation is occurring. Here are all the stats. The red shows areas where we have limited the DLOM, the Longstaff DLOM calculation to 100% because DLOM cannot ever be more than 100%. Here's a separate distributions of price volatility and marketing period in this example. That's always changes under your example, the cumulatives and the various distributions of these. So you can take this information into court and explain why you reached the conclusion that you reached. It's very powerful, and I recommend that you use it and use your coupons to test it out and compare it to the other methodologies that you're using. And if anybody has questions, if they want to talk, either email or call me. I'm happy to talk to people about this. I kind of live this a lot, and I have a lot of time that I'm willing to devote to help people through it. So feel free to contact me. And with that, I guess I'll end.
Oh, thanks. Thank you. On behalf of BVR, I want to thank Marc for joining us and for sharing his expertise. As a reminder, to receive CE credit, you must complete and submit a brief survey on this webinar. A link to the survey is provided in your login email and on the reading page for today's webinar. Your feedback is key to providing the best possible programs for you, so please provide us with any suggestions you may have. If you choose to fill out the survey now, your browser will automatically direct you to the CE credit page when I finish speaking, so don't disconnect. The survey will be active for 5 days and must be completed before we can process certificates. After 5 business days, we'll process your CE and send your certificates via email. If you have any questions related to the content or format of this webinar, please email me at training@bvresources.com. Coming up for more BVR webinars, on February 3rd, we have From the Front Lines of Business Valuation, Practical Problems That Keep Us Up at Night with Paul Hood. And on February 5th, we have What is the Future of Future Earnings? The Brooksby Case and the Condi Case with Jay Fishman, Jim Allarding, and Jim Ewart. You can find additional offerings on our calendar page as well under live events. Thank you all for listening. Have a great rest of your day. We're going to end this webinar now, so please go ahead and fill out the survey.